Right. So while people are still joining, I think we will kick off. Good morning, everybody, and thank you for joining us today. My name is Tom Reed. I'm a partner in the insurance team here at BDO. I'm joined today by my colleagues Alison Barker, who's a special advisor on regulation within our financial services advisory team, Ollie, who's a transaction services director, and Thomas, who's a BDO insurance tax partner. First of all, just like to say, I hope everybody's well. And then just to touch on a few housekeeping points. We are recording today's webinar, and we will circulate the slides and recording in a few days if anybody needs to refer back. Everybody's lines have been automatically muted, so hopefully there should be no interruption or feedback. And then also, if you would like to submit any questions, we will have time to answer questions at the end. There is a Q&A button at the bottom of the screen on Zoom, and if you submit questions through that, we will come back and answer those where there's time at the end. And if we don't have time at the end, we will follow up and send you written responses. So just in summary, what we'll be covering today, first of all, we're going to be covering a regulatory outlook, just what the key changes coming up are and what you need to plan for. Then we're going to touch on key trends in insurance intermediary M&A, and what to expect, what's coming. And then finally, we will run through the latest tax developments, risks, opportunities, and R&D tax relief. So with that said, I will pass you over to Alison, who's going to start with the regulatory update.
Good morning, everybody, and it's good to speak to you all this morning. As mentioned, I'm a special advisor in the regulatory advisory practice for BDO. My background is I was 12 years at the FCA in director roles, and prior to that KPMG, and prior to that in compliance roles as head of compliance for the TSB businesses at Lloyds Banking Group. What I'm going to run through today are some of the key sort of forward-looking regulatory issues that are on the agenda. We have a wide audience today, so I'm looking to try and cover both wholesale and retail. And also thinking about the backdrop we have of quite a dynamic economic environment, and also a change of government, which may, of course, change some of the regulatory priorities going forward. So that's sort of one to bear in mind. Ben, could we have the next slide, please? Just as a sort of quick overview, the topics I'm going to cover is diversity and inclusion and why that's so important on the FCA's agenda in relation particularly to culture, governance and innovation. Some of the key topics for wholesale markets are around the certainty of cover. So it will be no surprise, I think, to many of the audience to have thought about some of the issues that have been raised over the last couple of years with issues around the clarity in which cover is described, the transparency of cover, the pricing and product governance over insurance products. Resilience continues to be an important topic, and with the economic environment we have, the operational and financial resilience of all firms, whether wholesale or retail, will remain important. I'm not going to cover that in detail because it's a sort of well-trod path. For retail markets, I'll look at vulnerable consumers and particularly the cost of living crisis and the impacts of that for insurers, brokers and intermediaries, and also the consumer duty. And last but not least, a look at appointed representatives, which is an important aspect of the market, particularly in the broker and intermediary market. Next slide, please, Ben. So diversity and inclusion. So why is that important from the perspective of the FCA? There are some slides following which have set out the sort of key requirements that have come out in relation to D&I targets and annual reporting for listed institutions. But I think it's important to also think of why this is important from the FCA's perspective and also the PRA's perspective about creating inclusive cultures. The regulators do see diversity and inclusion as being a key part of creating cultures in which the right things are promoted, and also promoting different voices and diversity increases innovation. Next slides, please, Ben. So it is very much a direction of travel. And I think in my previous life, I also supervised the capital markets, and the read across from experiences in the capital markets to the insurance markets are that, particularly during the last crisis, a lack of diversity and inclusion was seen as a root cause of some of the reputational issues around market manipulation, and therefore the sort of increased focus on diversity and inclusion in creating the right type of culture to ensure that there's good governance and reduce the risk of groupthink is really important for regulators. Next slide, please, Ben. These next two slides actually just set out what the key requirements are from the most recent policy statements. We are expecting further announcements from the regulators very shortly, so those should be out in the next few days. But these slides just highlight some of the key requirements for listed institutions. Next slide, please, Ben. And so this just sets out who it applies to, and it may or may not be brokers and intermediaries, but it's, as I say, important to just understand what the key requirements are. Next slide, please, Ben. Cost of living. So this is a very topical piece for regulators. There has been a lot of announcements, particularly in the retail lending space, but I think there are specific things that apply in the insurance space as well. And being aware of how the financial pressures that consumers may be under, how those create vulnerabilities, but also how that may impact on people looking to make savings, possibly on their insurance products, and some of the considerations around that. Next slide, please, Ben. So I've set out some points here in a little bit more detail, but some of the things to be aware of might be consumers shopping around for insurance, maybe looking to increase excesses or cancel policies, whether that creates pressures on claims and complaints, whether firms are sufficiently planning ahead for those increases in consumer contact. There may also be increases in fraud, but regulators will be very aware that increased barriers to legitimate claims need to be balanced against investigation for fraud. Clear and unambiguous terms I've already mentioned, and ensuring that there's proper sort of support for consumers, particularly those who may be vulnerable or may need to be signposted to other services like debt services, may also be things to consider. Next slide, please. Another very topical area, and one which we have in BDO been supporting a number of firms on, is around the consumer duty. So brokers, intermediaries, particularly in the retail space, will no doubt be in the process of completing plans for scrutiny by their boards at the end of October. In the wholesale space, it's a more tricky discussion. The requirements for the consumer duty apply to retail consumers, and the FCA has been clear that certain types of products, for example, reinsurance, contracts of large risk sold to commercial customers, or other contracts at large risk where the risk is located outside of the UK, would not apply to the wholesale market. But at the same time, they are looking for wholesale markets to look through and see where there may be retail consumers at the end of the chain, and actually see whether there's a material influence over those, and ensure that they are thinking about the aspects of the consumer duty. Some of the key points would be again, going back to whether the cover is clearly explained, whether terms and conditions are clear, and whether consumers understand what they're buying. And I suppose that's a point actually for the smaller end of the commercial market as well. to ensure that that is in place, and that there aren't insufficient or there aren't significant barriers to consumers being able to make claims or make complaints, for example. One of the key points would be that if insurers, and it is quite a complex space for insurers and for brokers and intermediaries, but if all the work to comply with the various PROD rules has been undertaken, then insurers should be a really good way down the line in meeting the requirements of the consumer duty. The key points are, however, to make sure that particularly brokers and intermediaries are having the right discussions with the insurers or the risk takers to make sure that information is fed back and that brokers and intermediaries have the information they need to meet the requirements by the deadlines. So if we have the next slide, Ben. So this just sets out the key requirements. So there's a new principle, there are cross-cutting rules. The important one, for me anyway, is about avoiding foreseeable harm, which is a forward-looking aspect of rules which hasn't been in place before. And the rules and the principles look across 4 core outcomes, which are broadly the ones which the consumer may follow in their consumer journey. Next slide, Ben. This just sets out the timeline, and the key dates for brokers and intermediaries would be the October one to have plans scrutinised by the board. Manufacturers should be providing information to distributors, who will often be the brokers and intermediaries, or certainly the intermediaries, by April, and meeting the requirements should be in place by July next year. Next slide. Right, so my last area is appointed representatives, which are also requirements the FCA has issued and are particularly poignant in this sector because there's a great deal of appointed representatives. It's a model that is used quite widely. So the background to this is that the FCA, there's a huge number of appointed representatives. There's about 3,000, 4,000 principals. And then under those, about 37,000 appointed representatives who are effectively agents. And the overall reason that exists is it allows smaller firms to have access to the financial services market, but needs considerable tightening up. So all the requirements that are coming in are about tightening up the regime and ensuring there is more oversight of what appointed representatives are doing. Next slide, please, Ben. So some of these things form around providing more information to the FCA, more notification and more information and reporting. Some of that isn't all in place yet, but will be. Principals are going to be expected to provide more oversight and more monitoring and provide sort of annual attestations of what their appointed representatives are doing. And there'll be more information on the FCA register so that people can understand what it is an appointed representative can do. I've set out some of the requirements there, but it is quite a significant increase, and principals are expected to have the capability and capacity to monitor their appointed representatives, and appointed representatives can expect to have a great deal more scrutiny, and they should receive scrutiny over both their regulated financial business and also unregulated financial business, and possibly even unregulated business altogether, because it goes to the fitness and propriety of the representative. There are slightly more limited requirements for introducers, but again, they will also be included to some extent in the notification and reporting requirements. So that is a bit of a canter through some of the key things that are on the regulatory agenda and the key areas of focus in the sort of near mid-term for regulators, and it is quite a substantial agenda for firms to come up to sort of address. So those are my key points, and I think I am handing over to Ollie.
Thank you, Tom and Alison. Good morning, all. My name is Oladipo Oyeshimefun, and I'm a director in the transaction services team at BDO. This is a team of specialists that undertakes acquisition financial due diligence for buyers, vendor DD for sellers. We also act as reporting accountant to capital market transactions and generally provide these services in the mid-market for trade and PE. In particular, we also have a specialist FS team, which work closely with the tax, reg, and accounting advisor teams on an integrated one-team basis. Today, I will be briefly providing an M&A update on deal activity, the ownership concentration of top UK brokers, and some key macro takeaways. Next slide, please, Ben. So using data source from emerging markets, which are a financial data provider, we can see that the volume of deals come off a peak from Q1 2021, with 2022 being a lot more subdued. As most of you would know, the deal activity in 2021 was driven by two things. There was a delay in activity as a result of the COVID shutdown. And once this delay was and deal activity was restarted and a new normal stabilized, we saw a race for transactions to get completed in Q4 2020, where we could see things ramp up. Additionally, this was twinned with the anticipated changes in capital gains tax, which then resulted in a number of retirement sales, leading to a big uptake in transactions that were completed in Q1 2021. This uptake in transactions partly drove what we can see in the rest of 2021, where transactions sort of came down because a number of transactions that would have completed in the latter part of 2021, if not in later years, were effectively accelerated and completed instead in Q1 2021. So we can see this, this drop down in the volume of transactions, and just that was just what I'm talking to, just in terms of the top left chart there. Just staying with 2022 for the minute, I'm advised by a number of our M&A colleagues that there still remains, this market still remains a seller's market, with buyers increasingly beginning to cross-border, and in particular, we're seeing transactions where people are going to Ireland and also in mainland EU. Additionally, the wall of private equity money still remains, with a number of PE buyers are now beginning to match trade buyers in pricing. And we can see some of that in terms of, the fact that deal values are beginning to go up. And some of those increases in deal values are driven not necessarily by, growth in the businesses themselves, but more largely driven by this wall of money. They're constantly looking for businesses to buy, but there remains a limited supply of businesses available to be bought. Next slide, please, Ben. On this slide here, our M&A team puts together a private company price index, and which is just in the top left chart, and which in each quarter we collect data surrounding enterprise value to EBITDA multiples. This index tracks effectively the EV to EBITDA multiples paid by trade and PE buyers when purchasing UK companies. Now, this data is compared with historical data to sort of identify key trends. We can see that in this PCPI data that there's beginning to be a softening in the marketplace following the peak in last year, which I touched upon in the previous slide. What we can also see as well, which we'll all be familiar with, is that companies and businesses are beginning to face headwinds, a lot of macro challenges, with business owners beginning to fight on multiple fronts. However, what we're still beginning to see as well is that a lot of UK businesses are attracting strong interest from overseas. And a lot of that, some of that is actually driven by the pound beginning to weaken. And I think I was just looking at news articles from this week. I think the pound is at a 37-year low. So what we'd expect to see in this year is just continuing interest from overseas buyers coming into the UK and looking to buy UK businesses as well. The impact of the CGT changes, again, that's quite clear in the chart there. Next, please, Ben. There's been very limited changes in the type of ownership of UK brokers. So this slide here effectively is just a replay of one we did in a presentation last year, where the concentration hasn't really changed that much. What we're beginning to increasingly see is private equity buyers are beginning to sell to themselves, where a private equity company has invested in a broker, an intermediary in a number of years ago. They're beginning to either sell to other PE houses or PE-backed portfolio businesses themselves. Now, with the increase in the PE investment and PE capital, there is really not that much more in the mid-market for PE to buy, with the result that PE and private equity-backed businesses, as well as other bidders, also beginning to go international themselves. And we see that trend increasing. There's been a number of transactions this year, last year, in which private equity-backed businesses were effectively then sold on to other private equity-backed businesses. And in fact, in some of the instances, some of the large PE houses sold businesses from one fund to another fund that they control, which is an interesting thing to see happening in the market space. Next slide, please, Ben. Now, given that we're facing macroeconomic challenges in the UK, if not the global economy, given the increased headwinds with inflation, increased cost base, increased financing costs, we're beginning to see a number of transactions, especially in the larger deal size, that need a number of debt packages, where the debt packages are just not coming through from the banks and the financiers. Now, this is really just early development, so I think it's one space to just watch and see what happens there. But we're beginning to see some transactions not complete as a result of sort of debt packages being harder to arrange, which is not surprising given that we're all hearing about this consumer crisis and recession potentially coming to the UK. One thing to keep in mind as well is that over the last couple of years or so, we've all gone through this whole digital transformation journey as a result of the pandemic, with an increasing trend of technology-enabled intermediaries being in demand. Now, this is something that I think is still early days on, and there's still time to see whether that develops a trend. But what we're beginning to see is a lot of inquiries coming in, a lot of potentially, now this is not necessarily insurtech businesses, but just intermediaries that are using technology in what they do, beginning to see a lot of interest from buyers, and how that pans out is what I'd say, just watch this space on. What we think would continue to happen this year and in the years to come would be the increasing importance of private equity cannot be underplayed, because again, they still have this wall of money that's not really going anywhere. They're continuing to sort of be a main driver of deal activity. They have a lot of money, not just the UK ones, but also the overseas ones beginning to buy into the UK, especially investment coming from the USA and similar ones. And what we're beginning to see as well is that a number of entrants also beginning to coming from Asia Pacific into the UK as well, which is an interesting thing to see, with the result that inevitably deal sizes are going to go up, where you see some of the more established PE houses going up into much higher deal sizes, and some of the UK ones effectively going to the sub 5 million, sub 20 million pounds deal values for their transactions. This is something that I expect to see carry on into 2022, 2023. Additionally, we're beginning to see some of the established UK PE house, UK-backed businesses increasingly buying into Ireland, also mainland Europe, transactions in Spain, Italy, and some of the Nordic countries. And that's really just a really brief, if you will, summary of the M&A update. I'll now hand over to my tax colleagues who can provide an update.
Thanks, Ollie. Good morning, everyone. I'm Thomas Toe. I'm an insurance tax partner at BDO. I've worked in the sector for over 18 years now, advising various insurance groups on a wide range of tax issues, but essentially maximising the tax opportunities and minimising the risk. Next slide, please, Ben. Yep, so just as quick tax agenda. So I'll just talk briefly about the emergency budgets due to take place this Friday, and then an overview of the VAT hot topics, followed by R&D tax credits, which no doubt will be quite useful for groups looking for more cash. Next slide, please. Yes. Liz Truss. So Liz Truss is now our Conservative leader and Prime Minister, as you all no doubt know. And Trussonomics, has been labelled anyway, her focus is very much on tax cuts and no windfall taxes, and she's all about growth. So, you know, and that's been made very clear. And her Chancellor, Kwasi Kwarteng, as I said, we're making this emergency budget announcement this Friday. It was originally meant to be for today, but of course, because of the Queen's death, it had to be moved back, and there was some talk about whether it would happen at all. But it's definitely happening this Friday. And this is speculation, I suppose, but in terms of the possible changes that we're seeing, it's all about the tax cuts. And you know, I suppose one of the big ones is this reversal of the national insurance contributions increase of 1.25% that was brought in from this April. So that will be reversed. We expect it to be reversed from November. That'll be good news for employees and employers, because of course that was a tax on both parties. So as I said, that will probably come in expect to come in November. The corporation tax rate increase to 25% from today's 19%. Was due to come in April next year, but we expect that to be scrapped as well, which again will be good news to businesses. Other measures being talked about, you know, cuts to VAT, perhaps, cuts to business rates, scrapping limits on bankers' bonuses. And this morning, actually, I was reading that there may be a stamp duty reduction as well. I mean, other things include, you already heard from the ex-Chancellor Rishi Sunak about the reduction in the basic rate of income tax from 20% to 19%. He said that would come in from 2024. That might be brought forward, so you never know, that might be brought in now. There's also some talk about increasing the income tax threshold. So I suppose, you know, if you're a taxpayer, then clearly all that is good news. I guess the big question is, how is this going to be paid for? Because, you know, all this energy support will cost anything up to £150 billion. So with tax reductions, absolutely the big question will be, how is this going to be funded? You know, I'll just quickly finish before I pass on to my VAT colleague. This introduction of IFRS 17 insurance contracts tax legislation. I appreciate that this audience is an insurance intermediary, and therefore IFRS 17 won't affect you, but clearly it will affect your any risk carriers you might work with or actually might have in the group. So this will be a big change, but we're hoping anyway that some legislation will be introduced pretty soon in this emergency budget, because IFRS 17 starts from the 1st of January next year, so not much time. On that pleasant note, I will now hand over to Aditi, who will cover VAT.
Thank you so much, Thomas. I'm Aditi Hyatt. I work in VAT, part of the insurance tax team, and I've been doing this job for about 18 years and loving it. I'd like to talk to you about a few key hot topics that we are seeing businesses in the insurance sector talking about, and things that are affecting these businesses. Brexit, as we know, obviously has happened for a few years now, and lots of businesses have made changes to the way they have been operating after Brexit. One of the things often we find is that although businesses have now settled down and have made changes, or not, depending on the model they haven't necessarily considered how the implementation has gone through. And what that has often meant is VAT is perhaps being charged when it shouldn't, or perhaps VAT is being recovered when it shouldn't. The biggest benefit of Brexit we found is particularly for insurance related services, particularly when you're supplying to EU businesses. It helps unlock VAT recovery. So pre-Brexit, you couldn't have got VAT back on your costs, but this obviously is a new avenue. So it's just making sure that your systems are in place that helps you get benefit of this, because not many businesses have necessarily implemented the systems and processes to capture the most out of this benefit. At the same time, and this is something again people sometimes forget, is that this VAT benefit also comes with a certain caveat. And this is in situation where you're providing insurance intermediary services to someone overseas, but it relates to an insurance contract where the policy holder is in the UK. Those are the situations where you would not normally be able to recover any VAT. And often businesses miss that. They don't necessarily have processes in place to identify where their service is ultimately being consumed, where the policyholder is located. So it's just something worth to think about. There is also a wider piece around looking at how are you recovering your VAT, and is the method that you're following, is that optimum? Sometimes you'll find that businesses don't have any method in place at all. So they're following a standard method, which often gives adverse results, particularly for businesses in the insurance sector. So many businesses use an alternative special method, which is usually agreed with HMRC. But often we found situations where the special method that's been agreed, it's not necessarily been updated for a while. And particularly if you've had changes in the business or it's been many, many years, it's really worth looking at it to make sure it's optimum, particularly in this post-Brexit world. So that's topic number one. The second thing, particularly if you're talking to tax experts, you'll often hear words like HSBC, Scandia, Danske Bank, all these sorts of VAT cases being hurled across. And these are very complicated topics, but if I was to very briefly simplify it, all these cases are effectively suggesting is look at how, particularly with businesses with overseas structures, look at how you're operating from a VAT perspective. Look at how the transactions that are happening in the UK versus your offices overseas. How are you reporting that from a VAT point of view? And the reason I'm flagging is that basically because of these new cases, the understanding has evolved. So things where we would have normally expected no VAT to apply, particularly in situations where you have a branch head office structure, in certain situations, that rule is changing. So effectively that particular transaction could become taxed. To make things even worse is when you speak with countries outside the UK, different countries are implementing rules slightly differently. So which means that you have to navigate and understand exactly what transactions are going on in which jurisdictions, how are the jurisdictions interpreting all these cases on establishment, and what impact that has, and just balancing that from a UK point of view versus an overseas point of view. The other area where we are seeing HMRC particularly look at establishment is situations where if you have an office in the UK and that's not actually making supplies to third parties, so it's effectively servicing a group head office, for example, overseas. We have seen more questions from HMRC in terms of, well, that particular office is not necessarily meeting the test for establishment, meaning they shouldn't register for that. So it's worth thinking through, particularly if you have overseas structures, is it's worth taking a step back and asking yourself whether the changes that we are seeing, and this is not settled, so the case law hasn't settled, but it's worth taking stock of understanding what impact that has on your business and whether something needs to be changed. Making tax digital. So this has been a topic that's been bandied around for years now. So hopefully you all are aware about this. But put very briefly, these are new rules that HMRC brought in to make sure that businesses can prepare, store data, prepare VAT returns in a digital way. And also more importantly, the returns can be filed using a special software. It's called a bridging software. So instead, in the old days, you would go online, register and put manually insert your numbers and it's all done. You can't do that anymore. We have seen announcements from HMRC where they're making the rules even tighter. So for those of you who are particularly still using the old method of filing VAT returns, HMRC said that they're going to stop that service from 1st November. So if you are in one of those situations, it's worth looking at it and making sure that you've got necessary alternatives in place so you can make sure you can file returns in the proper way. The last point is on insurance intermediary. So again, we've seen so much case law over the years on what constitutes an insurance intermediary service. And sometimes the taxpayers win, sometimes the taxpayers don't. A recent case came out from the European courts. It's called the Q case. I'm pretty sure the taxpayer's name is not Q, but they use it for anonymity reasons. But effectively, the taxpayer was providing an insurance product. So it created an insurance product and it licensed it out to insurers. And the court found that that's not technically an insurance intermediary service, so it should be subject to VAT. In the UK, we've seen a case of Stay Sure. It came out very recently. And that case, again, looked at insurance intermediary, among other things. And it looked at technology. So the taxpayer was buying technology-related services, which helped them find potential insurance customers, policyholders. And the court said that actually what they're buying is a very sophisticated service and should fall within the insurance intermediary exemption. So again, it's hugely important for insurance agents and brokers is to look at what supplies are they providing. Does that fit within the test of insurance exemption? And if there's any risk, we've had many other cases is very similar. So we had one other case which didn't make it to court, but we very successfully helped our client win the case outside court, and HMRC accepted again that the taxpayer was essentially providing an insurance intermediary service because it was doing a lot in terms of bringing parties together. So it's a really quick whistle stop, but you know, if you were to take away one thing away from this seminar, particularly on VAT, I would say is just take a stock back, reassess in terms of how your position is from a VAT point of view, and what impact these changes are having on your business, and have you taken the right sort of actions in place to make sure you're ready and protected. I will now hand over to my colleague, Lauren. Thank you.
Perfect. Thank you, Aditi. So my name is Lauren Wilson. I'm a manager in the financial services R&D team here at BDO. We are a large team nationally of around 100 tax specialists and technical personnel that focus on R&D tax credits with different sector specialities. I have been specialising in R&D and patent box for coming up 6 years and working in tax for a little bit longer. I'm going to talk for a few minutes about R&D tax credits. I'm sure many of you may have heard of R&D credits before, but for those who might not be aware, R&D tax credits are a government incentive designed to reward companies for innovation. For a company that is considered large, the net benefit is worth around 11% of qualifying expenditure and is accounted for above the line. For a company that is considered small, it's worth up to 33% of qualifying expenditure, dependent on the tax position of the company. I've highlighted some projects here that often people think are not eligible on the basis that they're not undertaking blue sky research, but the R&D definition is actually far broader than people may think. For example, appreciable improvements to platforms where a lot of uncertainty existed can be considered qualifying. So moving to the expenditure, the bulk of expenditure in an R&D claim is often staff costs, so salary, bonus, employer's pension and national insurance contributions, and also externally provided worker costs. but it's also currently possible to include staff expenditure that is incurred overseas and recharged back to the UK. For example, in a group scenario where overseas staff are supporting the UK with their R&D efforts. This is due to change for accounting periods that begin on or after the 1st of April 2023, when that category is no longer considered a qualifying cost. It's also possible to include indirect staff who may not directly be working on an R&D project. They can be included to the extent that they were supporting R&D staff, and software licenses can be included to the extent that they were used within the R&D process. As I mentioned a few moments ago, there are some changes coming to the R&D regime from the 1st of April 2023. The draft legislation has been published and highlights some of the proposed amendments. Overseas staff costs will no longer be eligible, but on the other hand, to support the growing volume of R&D that is underpinned by mathematical advances, the definition of R&D for tax purposes will be expanded by clarifying that pure mathematics is now a qualifying activity. And the scope of software costs has been expanded to allow data licenses and cloud computing. So that's data storage, operating systems, software platforms, and hardware facilities to be included within a claim. There's also a bigger focus on tackling abuse of the system. When it comes to the validity of claims being submitted, HMRC recently hired an additional 100 inspectors in order to deliver a more robust and consistent review of R&D submitted claims. This tackling of abuse will be implemented in a few different ways. So all claims will need to be made digitally, and companies will need to notify of the intention of making a claim within 6 months from the end of the period to which the claim relates, unless that company has already claimed in one of the preceding 3 accounting periods. Claims will also require the endorsement of a named senior officer of the company, and they will also need to include details of any advisory agent that's supported as part of the submission. Finally, we do have an R&D benchmarking toolkit, which benchmarks and risk assesses R&D tax credit claims against companies of a similar size in industry, and we can offer a fresh pair of eyes over R&D claims. So that brings me to the end of the R&D update. And I think I'm passing back to Tom here.
Thank you, Lauren. So thank you all for those presentations. We do have a couple of questions which are in, but if you'd like to submit any more, the Q&A button at the bottom is there, so please do submit. The questions we've had actually both relate to the same thing, so I'll pass over to Alison as we have a question about the consumer duty date. So I will pass.
Yes, thank you, Tom. Yeah, so the question is, the consumer duty October date, would this stand for wholesale reinsurance also? I think just the key point is whether the consumer duty actually applies to wholesale reinsurance. I think the guidance that the FCA has set out is that it wouldn't apply to reinsurance. So the first question is whether a wholesale whether the consumer duty applies at all, and the way to answer that question is actually to complete an impact assessment and actually understand whether the consumer duty does apply to your business. And I know it's quite complex in the insurance world because of sort of very long supply chains. So having first established whether the consumer duty applies or not, if it doesn't apply, then clearly the October date won't apply. If it does apply, then for whatever reason in the business that you have, then yes, the October date would apply if the consumer duty applies to your business. Hopefully that makes sense. So the first question is one of scope and application.
Thank you. Sorry, Alison. Go.
That's it. Yes, I didn't. Wasn't going to say anything more.
No, sorry, they're actually both related to the same thing. So with that said, thank you all for attending. We don't have any more questions there at the moment, but if there are any, please do submit before I finish closing and we'll answer. If not, please drop us an email afterwards and we'd be happy to pick up and respond. As we said, the slides and any recording will be made available to anybody who would like them after this. And all that leaves for me to do is to thank the speakers again, and thank you all for joining us, and hope you have a good remainder of the day. Thank you.